Did you know that a well-diversified investment portfolio is one of the most powerful tools for managing risk and maximizing returns? Whether you're a beginner or experienced investor, spreading your investments across different asset classes can help protect your wealth and grow it over time. In this video, we'll guide you step by step on how to create a diversified portfolio that works for you. Before we dive in, don't forget to like, subscribe, and hit that notification bell so you never miss more expert investment strategies. Let's get started. Creating a diversified investment portfolio is one of the most essential strategies to reducing risk while increasing the potential for returns. Diversification is the practice of spreading your investments across different asset classes, sectors, geographic regions, and types of investments. By doing so, you minimize the risk that any single investment or market event will significantly affect your overall portfolio. 5. Determine the right asset allocation. Your asset allocation is one of the most crucial decisions you'll make when building a diversified portfolio. Asset allocation refers to how you divide your investments among different asset classes like stocks, bonds, real estate, and commodities. The right allocation depends on your financial goals, risk tolerance, and time horizon. Financial goals. Your objectives should determine the proportion of risk you're willing to take. For instance, if your goal is long-term growth, such as retirement in 30 years, you may be comfortable with a higher percentage of stocks in your portfolio, as they historically offer higher returns over the long term. If you're saving for a short-term goal, such as a home purchase in 5 years, you might allocate more to bonds and cash equivalents to preserve capital. Risk tolerance. Everyone has a different comfort level with risk. Younger investors, or those with a higher risk tolerance, may choose a stock-heavy portfolio, as they have the time to recover from market downturns. Those closer to retirement, or with a lower risk tolerance, may prefer a more conservative approach, favoring bonds and cash equivalents that offer stability but lower potential returns. Generally, a balanced portfolio might include around 60 to 70% in equities, stocks, 20 to 30% in bonds, and 10% in cash or alternative investments. Your specific allocation should align with your financial goals and risk profile. 4. Diversify within each asset class. While choosing asset classes is important, diversifying within each class is equally critical to managing risk. Diversification reduces the likelihood that poor performance in one area will significantly impact your entire portfolio. Stocks. Within the stock portion of your portfolio, aim to invest across various sectors such as technology, healthcare, consumer goods, and energy. This way, if one sector suffers, technology, during a market correction, your other sectors might perform well and balance out the losses. It's also important to include both domestic and international stocks. Investing internationally helps protect your portfolio from local economic downturns and political instability. You can diversify in stocks through mutual funds or ETFs, exchange-traded funds, that track broad indices such as the S&P 500 or emerging markets. Bonds. In the bonds section of your portfolio, diversify across different types of bonds, such as government bonds, municipal bonds, and corporate bonds. You can also vary the maturities of the bonds in your portfolio. Short-term bonds tend to be less volatile, while long-term bonds typically offer higher returns but carry more risk. A mix of both types can help you achieve a balance between safety and growth. Bond ETFs or mutual funds can also help spread risk among various bond issuers. Real estate. Real estate is another important asset class. Instead of investing in a single property, consider diversifying by investing in real estate investment trusts, REITs, which offer exposure to a wide variety of properties: commercial, residential, industrial. Real estate can be a stable income-producing asset and helps offset stock market volatility. 3. Choose asset classes for your portfolio. Selecting the right asset classes forms the backbone of your diversification strategy. A well-diversified portfolio typically includes a mix of stocks, bonds, real estate, commodities, and cash equivalents. Each of these asset classes serves a different purpose in your portfolio, balancing risk and return. Stocks. Stocks have the highest potential for growth, but they also come with increased volatility. Over the long term, they tend to outperform other asset classes, but in the short term, they can fluctuate wildly. Stocks are crucial for younger investors who have more time to recover from potential losses. Bonds. Bonds are generally less volatile than stocks and provide a steady stream of income through interest payments. They are less likely to experience sharp drops in value, especially in times of economic downturn. Bonds provide stability to a portfolio, particularly for individuals closer to retirement. Real estate. Investing in real estate, whether through direct property ownership or REITs, can provide both capital appreciation and rental income. Real estate can act as a buffer against stock market volatility, as property values don't always move in tandem with the stock market. Alternative investments. These include private equity, hedge funds, venture capital, and other non-traditional assets. While alternative investments can be riskier and less liquid, they can offer unique opportunities for growth and further diversification, especially when combined with more traditional assets. 2. Understand your financial goals and risk tolerance. Before constructing your portfolio, it's essential to have a clear understanding of your financial goals and risk tolerance. These two factors will directly impact the types of investments you select and the amount of risk you're willing to take on. Financial goals. The first step is to clearly define your financial goals. Are you saving for retirement, a child's education, a house, or simply wealth accumulation? The time horizon for each goal will affect the way you structure your portfolio. Long-term goals like retirement may allow you to take on more risk, as there's more time to recover from short-term market fluctuations. For short-term goals, however, you may want to prioritize safety and preserve your capital. Understanding both your goals and risk tolerance allows you to make informed decisions about asset allocation, helping to balance potential returns with an acceptable level of risk. 1. Rebalance your portfolio regularly. Building a diversified portfolio is an ongoing process. Over time, changes in market conditions or asset performance will cause your portfolio to deviate from its original allocation. To maintain your desired risk and return profile, you need to periodically rebalance your portfolio. You should rebalance your portfolio at least once a year, but it may be necessary to rebalance more frequently if there are major changes in the market or your personal situation. Approaching retirement, a change in income, or a shift in financial goals. Some investors set rules to rebalance when an asset class moves 5 to 10% above or below its target allocation. What do you think of our video? Let me know in the comment section below. Also, subscribe to our channel before you go. Thanks for watching.